Good morning, subscribers, and today I'm putting out a video for my Year 13 students with regard to sort of demystifying and just bringing to an end this whole notion of financial markets, which for those of you studying the OCR specification, you will know that this is chapter 20, the final chapter of the A2 macroeconomics syllabus. So let's get to it and let's just bring all this together. All these things in the OCR textbook, it is a little bit bitty, and so I just want to bring it all together in this video. So it might be a slightly long video. I do apologise from the very outset, ladies and gentlemen, for that. But I'll try and just whiz through the basic fundamentals of this as quickly as I can. So, you will of course be familiar with the fact that a market, be that for goods and services, a market is any situation in which buyers are brought into contact with sellers. And as long as money exchanges hands, then a good or a service can also be exchanged. Well, think of a financial market in very much the same way. A financial market is bringing the buyer into contact with the seller, but we're thinking in terms of the buyers and sellers, we're thinking about bringing borrowers into contact with the lenders. So that's the first key fundamental point here. It's borrowers being brought into contact with lenders. Now, who might those borrowers be? Well, borrowers could be consumers. Of course, you and I, we may wish to buy a new sofa, a new television, a new car, whatever it may be, and so we will require a loan from the bank. It may be the government. The government will obviously, certainly our government, given the debt situation in which we found ourselves, ladies and gentlemen, they will be wanting to issue on a fairly consistent basis, they will be issuing bonds in order to raise finance and capital. And of course, that happens, those bonds, you'll know that bonds are also referred to as gilts, and gilts are now handled, the issue of them are now handled by the Debt Management Office. And I was having a little look, ladies and gentlemen, a little peruse just the other day at this. So this is, if you Google the Debt Management Office, you can go to the gilt market, and here you can see details about how to buy and sell gilts. Quite interesting, really. Just if you're interested and have a little bit of time to spare, you can look there about that. And then of course finally, firms, expansion plans, new machinery, that type of thing, they will obviously require a loan in most instances, unless they're sitting on an enormous debt pile. Well, who provides the capital in order to make this work? Well, the capital to make this work comes from the savers, and the savers of course lodge the money in the bank, but the bank, as you well know from your studies of banking and the banking system, the bank don't just sit on that cash, they will lend it out in order to make a return on it, because of course the commercial banks, your HBOS and your RBS and so on, they are predominantly, almost now, privately owned, profit-seeking enterprises, and as a consequence of that, they make money, they make profit on the interest rate differential. So if, for example, your savings accounts pay next to nothing, ladies and gentlemen, these days, don't they? Let's say your savings account pays 1%, while your bank will be issuing loans to the tune of maybe a mortgage on which a household might be paying 5% or 4% or 3%. And it's that differential between what the bank earns on the mortgage and what they have to pay out to the saver, that is where they are making a lot of their profit from. So that's the interest rate differential. Now, of course, it's, as I've just shown you, you could go to the Debt Management Office yourself and you could have a little look on that website and you could find out exactly how it is that you could go about buying and selling gilts. However, sometimes it's better to go via an intermediary, so a financial intermediary. So who might that be? Well, a commercial bank is a financial intermediary because they will take your money and they will then make loans on it. They will try to earn a return on that saving which you have deposited with them. investment banks dealing with mergers and acquisitions. They will be a financial intermediary. Pension fund holders, pension fund managers who take whole enormous pots of money, and then they invest it in the stock market in various stocks and shares, obviously in order to make a return for themselves, but also to make a return for the pension fund. So the Teachers' Pensions Association will be making, I hope, low-risk investments, because I'm not a risk taker, making low-risk investments on my behalf, so that when I retire in quite a few years' time yet, they will then be able to produce for me some type of annuity or substantial return on my investment over the 40 odd years of teaching, whatever it might be. So these are your financial intermediaries. You don't really need to know a lot about them, but you obviously need to be aware that such intermediaries exist. Now, all of these things will be going on in the money markets, or maybe if it's a bank buying and selling, it could be buying and selling shares or currencies, then you'd be working in the currency markets or the forex, or the capital markets where you're buying and selling debt or buying and selling stocks and shares, that type of thing. But you'll have come across, I'm sure, this whole notion of the money market and the way in which the actions in the money market then feed into the real economy. Now, by the real economy, ladies and gentlemen, what do we mean? Well, we're primarily thinking there of looking at economic growth, looking at economic output, looking at inflation, and looking at employment. And as you well know, the Bank of England, whilst it has an eye on target 2.0, our inflation rate target, it also has to be keeping the other eye on the broader macroeconomic picture. So it needs to be considering these other things as well. And there are certain interventions that the Bank of England can make in the financial markets in order to either stoke up growth or to increase output or to reduce unemployment, dependent upon the macroeconomic circumstances. And you'll have come across this in your studies of the transmission mechanism. Now, if you're not 100% au fait with the transmission mechanism, do search my channel and you will find a link, I'm sure, to the transmission mechanism. But the basic gist of it is that the money market, changes in the money market, feed into the real economy, which then affect AD, possibly AS, and as a consequence of that, we can manipulate the components of real output and obviously the price level as well. I'm sure you're familiar with the fact that money demand slopes downwards from left to right. Why is that? Well, people's demand for cash balances when the interest rate is low, the opportunity cost therefore is low, and by that I mean the opportunity cost of holding cash in your back pocket is low, so people hold lots of cash, and vice versa. When the money demand is low, the interest rate is high because it's more it's a greater opportunity cost to hold it in your pocket than to put the money in the bank, because there are no greater return in the bank. So that's money demand. Money supply, generally speaking, we tend to think of it as this perfectly inelastic scenario, purely because it's controlled and centrally fixed by the central bank, Bank of England. And so where these two intersect, we then get the price of money. And of course, the price of money is, another word for saying the price of money, is that we then are able to determine the interest rate, R1 in this case. Now, you'll know, those of you who've looked at my other video on transmission mechanism, we could be drawing an investment demand diagram in between these as well, but I'm not going to go into that. For the purposes of today, all we're saying is that in the money market, this interaction of demand and supply might lead to that level of interest, which is equivalent to this level of aggregate demand in the economy, and hence, of course, this level of real output. Now, what happens if you wish to increase the level of real output? Well, if you want to increase the level of real output, you need to increase aggregate demand. And in order to increase aggregate demand, the Bank of England can intervene. So how might they intervene? Well, most interventions by the Bank of England, certainly in the UK, most interventions come via the money supply rather than the money demand. So it might be the case, for example, that, let me just sort this out, it might be the case that the intervention is in the form of an increase in the money supply. So we go to MS2. Now, as a consequence of that, I'm sure you can see the interest rate falls. That would then have a stimulus effect on aggregate demand, as I'm sure you know. So the interest rate sensitive components of AD will all start to rise. So consumption will rise, investment will rise, net exports will rise through a combination of export prices being cheaper and import prices being more expensive. And as a consequence of all of those factors, the aggregate demand curve may then shift, let's say, around to AD2, where we now have a level of real output of Y2. But of course, we also have an increase in the price level, so we've gone P1 up to P2 in this instance. So that intervention directly by the Bank of England, and we'll come back to how this can take place, that can reduce the interest rate, which then stimulates aggregate demand in the economy. Now, you'll know, I'm sure, and you'll be thinking to yourselves, well, if we go in the other direction, so if rather than going MS2, we went MS3 in this direction, the interest rate would rise, and as a consequence of that, AD would be shifting to the left. And we get all of the negative multiplier effects that would come as a consequence of that. But I do, ladies and gentlemen, want to draw your attention to this very important quote, which indeed was on one of the specimen A2 papers. Milton Friedman, inflation is always and everywhere a monetary phenomenon. Very commonly obviously associated with this quantity theory of money, where MV is said to equal PT. Now again, I do have a video on this, so I'm not going to go into this in too much detail. Suffice to say that the basic gist of this is that if you increase the money supply, according to the quantity theory of money, the Fisher equation as it's sometimes referred to, if you increase the money supply, you then increase the price level. And you can see here, for example, as we've increased the money supply and AD has moved around, the price level has increased. Now, if you wanted to illustrate this in in its classical context, in the classical economics context, then obviously you would be drawing the classical aggregate supply curve, AD shifting right, and the only result is P1 up to P2. And of course you could substitute CAS for the long run Phillips curve, and you could have your short run Phillips curve running across this as well. So all sorts of ways that you could demonstrate that. I'd watch out for a question on that, for an essay question by the way. But anyway, we can say that, and we know that in this particular theory, V and T are assumed to be constant for a number of reasons, not that I'm going to go into them now, but if that means that if you double M, you double P. That's the general gist of it. Now, the Bank of England, in order to manipulate this and in order to control the macroeconomy, the broader macroeconomy, they can of course intervene on the money supply side of things in order to either reduce the rates of interest or increase them, and consequently have an impact on the real macroeconomy. So let's just consider the three ways in which they might do that. Number one, reserve requirements. So reserve requirements, you know that the Bank of England is also known as the lender of last resort. So when retail banks, high street banks, want some cash, they can go to the Bank of England, they can draw down funds from the Bank of England. And that is as the lender of last resort. However, the Bank of England can also require commercial banks, retail banks, to hold a certain proportion of their cash balances and their deposits at the Bank of England. So let's just say that Halifax Bank of Scotland has got £100 deposits and the central bank says, right, well, we want 10%. So obviously they would take £10. Now that then obviously reduces the quantity of money that's in circulation with the retail banks rather, and consequently the money supply will shift in this direction to MS2. And you can see as a consequence of that intervention, the money supply shifting left forces the interest rate up to R2. And as a consequence of that, you know that AD would then start to shift round in this direction. So if the Bank of England wants to, or if this central bank wants to increase the rate of interest, it can increase reserve requirements, because if they said, right, we don't want 10%, we want 50%. So that is taking even further liquidity, ladies and gentlemen, out of the banking system. You know that liquidity is the speed and certainty with which an asset can be converted into cash, cash being the most liquid of the assets. So you're taking liquidity out of the system, that forces the rate up. On the other hand, of course, they could say, right, well, we will reduce the reserve requirements, in which case that would inject liquidity into the banking system, and as a consequence, money supply shifts right to MS3, interest rate falls to R3, and AD this time would shift in this direction via the multiplier, the accelerator, whatever it may be, and as a consequence of that, you get an increase in real output. Now, this type of thing doesn't really go on much in the UK because primarily they use the cash deposit ratio, the commercial bank's cash deposit ratio system in order to control this. So the Bank of England will stipulate to the commercial banks what their ratio of cash to deposits will be. So if they have, for example, a cash deposit ratio of 10% on a £100 deposit, that means that the bank can keep £10 and make loans of 90. However, if they were to increase the cash deposit ratio, say to 20%, then that would mean that the commercial bank has to keep £20 and it can only make loans to the tune of £80. So that helps to keep a bit of a lid on the growth of the money supply. So that's the first one. Secondly, the bank rate. The base rate, probably you're most commonly familiar with hearing it, 0.25%. It's at an historic low, according to yesterday's Sunday Times, the 14th of May 2017, saying that it's been at an historic low, just an historic low for 99 months, ladies and gentlemen, which is pretty much a record since 1952. It hasn't been as a lower rate as that for such a sustained period of time. But anyway, the bank rate. Again, this relates very importantly to this whole notion as the Bank of England as the lender of last resort. So if commercial banks need to draw down funds, they will be charged the bank rate, and obviously vice versa is the case. Now, if the central bank wants to reduce the money supply and take a little bit of liquidity out of the system, then they could obviously increase the bank rate. Consequently, that makes it more expensive for the commercial banks to borrow, and as a consequence of that, there'll be less of that going on, and so the money supply will be shifting to the left. On the other hand, if they wish to increase liquidity and bring interest rates down, then they can reduce the bank rate. And obviously all of the actions and the interventions that we've seen since the Great Recession have all been trying to keep the interest rate low in order to stimulate demand and to generate economic growth in the economy. And then that finally brings us, ladies and gentlemen, to this one, open market operations, of which there are two kinds, open market purchases and open market sales. Now, you may be familiar with this notion of open market purchases as quantitative easing. So open market purchases open market operations involves the buying and selling of government bonds. So if it's purchases, then the Bank of England buys the bonds from the retail banks. Now, the retail banks in receipt will obviously get additional cash and additional liquidity, and that additional liquidity would shift the money supply curve to the right. On the other hand, if they engaged in open market sales, then the Bank of England would be selling bonds and as a consequence of that, the commercial banks would receive the bonds, but obviously they have to pay for them. So that then takes liquidity out of the system, which would shift the money supply curve to the left. Now, you will know, I'm sure, that quantitative easing in this country at the moment stands at 435 billion in terms of gilt purchases, government bonds, and then an additional 10 billion in corporate bonds in the UK economy. So we are operating quantitative easing and open market purchases. It's just open market purchases on a grander scale, really. And of course, it's happening in the United States, happening in Europe, probably to a much greater extent than we have it in the UK. So, ladies and gentlemen, that I'm going to bring it to a close there. So this is the way in which the Bank of England can intervene in the money market in order to manipulate the level of real output and the size of the real economy. So I apologise, this has been a little bit of a long one, but it does sort of tie up a few loose ends with regard to chapter 20. So I hope the revision is going well, ladies and gentlemen. Just waiting my students coming out of the AIS micro exam at the moment. And I wish you every success in your A2 exams. Bye for now.